Okay.
Otherwise we're going to run. So,
Okay.
Alhamdulillah. Bismillahirrahmanirrahim. Mufti Ismail Desai, for the benefit of our listeners and those that are on the Zoom. Mufti Ismail Desai is an internationally reputed Sharia scholar and Islamic finance expert, if I might say. He has been involved and developed many structured products like the sukuks, trade finance, involved in their corporate restructuring, etc. And he is presently the CEO of Global Islamic Finance Services. Am I right, Mufti Saab? And today, Mufti Saab will be deliberating on a topic. The topic being how Sharia finance tools can solve business debt. This is a very interesting topic, and I'll be all ears with that. And then at the end, hopefully we'll have a few minutes for some questions and answers. Jazakallah, and thank you, Mufti Sahib. You can now take over.
Bismillahir Rahmanir Rahim. Nahmaduhu wa nusalli wa nusallimu ala rasulih al-kareem amma ba'd. Firstly, I would like to take this opportunity to thank the management of Minara Chamber of Commerce, especially our respected brother Salih Suleiman, our brother Razak, and all the other directors of the Minara Chamber of Commerce for doing a sterling job during this very difficult time of COVID, and also for putting together this important webinar and online event. I'd also like to thank you, the participants, for taking out the time early on a Saturday morning when you might have been busy with other chores, and maybe some of you would normally catch up with sleep, etc. For having taken out the time to attend this event. This event would cover several aspects, including an introduction to Islamic finance. Secondly, it will cover some of the basic principles of Islamic finance. We will also cover some of the contemporary concepts of Islamic finance, like Islamic trade finance, Islamic bonds or sukuk, takaful, Islamic insurance or Islamic indemnification. And it will also cover Sharia audit and governance. Many of the topics here would not be covered simply because of time, but we will leave the slides with Minara, and you would be able to access them, and you would also be able to access a recording of this program thereafter. So we begin with the credentials of GIFS, Global Islamic Financial Services. Alhamdulillah, we have been involved in advising and structuring products globally. As you can see, we've been involved in various institutions, including Infinity Consultants, which is the first ever Sharia investment vehicle in India, Botswana Life Insurance Limited, which is the largest insurer in Botswana, Hijaz Financial Services, which is the largest Islamic financial services provider in the Australasia region.
Mufti Sahib?
So we now move over to slide number 8, which discusses an early history of Islamic finance. So basically, Islamic finance was established during the period of the prophethood of Rasulullah sallallahu alaihi wasallam, and Islamic finance basically refers to finance that is in line with Islamic and Sharia law. We find various examples of this, where the Baytul Mal was established, what is called the treasurer or the public treasurer during the time of our Prophet Umar radiallahu ta'ala, one of the Khalifas and successors of our Prophet sallallahu alaihi wasallam, used to inspect the marketplace and ensure that no one who had knowledge of Islamic finance, unless you had knowledge of the Sharia laws of business and economics, you would not be permitted to enter the marketplace. So you have several of these concepts like Sayarifa, which refers to Islamic money exchanges, the Baytul Mal, which is the public treasury, equivalent to what is called a central bank in the current age. You had the public sector, and obviously zakat played an important factor, and you had the Ashabul Suq. So the Ashabul Suq refers to public monitors or individuals who would then inspect the marketplace to ensure that the laws of Sharia with regards to finance and economics were being implemented. Then you find that in this historic era of Islamic finance, many of the Muslim states had been colonized, and therefore a conventional economic system was implemented by the colonizers and the imperialist forces. And there was an entire period of development for the Islamic economic system that was completely in the dark. Once these Muslim countries started to receive independence, then you find that there was an interest in terms of, and there was a desire in terms of developing the Islamic financial or economic system. So the first perhaps example of this is what is called the Mutghamar savings project in Egypt. You had many of the farmers in the Nile River Valley that wished to ensure that their savings were Sharia compliant. That is, they would not earn interest on their funds. So they then pooled their funds together to create what is called a cooperative or a savings cooperative in terms of saving their funds, investing it in a Sharia compliant manner, and then receiving a Sharia compliant profit. This Mutghamar savings project in the early 1940s was transformed eventually into what is called today as Faisal Bank. So Faisal Bank in Egypt is one of the largest banks in Egypt today. It was declared an official Islamic bank and is currently owned by the Egyptian state. So one can see that with sincere intentions, how far those sincere intentions can take an entire community. So just a mere savings project took everyone to what is called today as Faisal Bank. So this was established in the early 1900s. Then you find Dubai Islamic Bank and the Islamic Development Bank were established in the 1970s. Perhaps one of the earliest examples of a sukuk or an Islamic bond was issued by the Ottoman Empire in 1885 for a tobacco project. And then the Islamic capital market was established between 1955 and 1974. That is, you find the DFIs or the Development Financial Institutions were established. Number 7, you see Tabung Haji. So Tabung Haji is basically an Islamic savings project that was established by the Malaysian government, basically for Malaysians to save money to go for Hajj. Now, those of you who've been to the Holy Lands would know that you'll find that there's certain buildings that are called Tabung Haji. So Tabung Haji refers to the Hajj Fund of Malaysia, the official Hajj Fund of Malaysia. This entire fund is based on Sharia compliant principles, where every Malaysian contributes to the fund, and they are then guaranteed Hajj once in their lifetimes. We move over to the next slide, and this is basically a snapshot of the development of Islamic finance. So you can see there that in 1970, you had retail banking moving over in the 1980s to Takaful or Islamic insurance. In the early 1990s, you had much more sophisticated products like funds. And in the early 2000s, you had advanced treasury services like the Tahawut or Islamic Master ISDA agreement. You had Tawarruk structures and much more advanced structures, etc. That is basically a snapshot of the early development of Islamic finance. And now we move over to the actual principles on slide 10, which discusses the sources of guidance for Islamic financial operations. So essentially, Islamic finance is what the term says, that it is finance that is based on Sharia law. And Sharia law is essentially derived from 4 sources. The first is the Quran, the second is the Sunnah, which is the Hadith. The third is ijma or consensus. So where there are certain issues which are not explicitly mentioned in the Quran and Sunnah, then it is discussed via ijma. It is based on consensus. That is, all of the scholars, convene, and then the matter is resolved by ijma or consensus of the contemporary scholars. And if there is no ijma, then we have what is called qiyas or analogy. So say, for example, there is a contemporary issue which is not explicitly mentioned in the Quran. A simple example of it is IVF or intro-vitro fertilization permitted in Sharia? So obviously this is not discussed in any of the sources of Sharia. So based on qiyas and analogy, that is, the scholars will then apply one scenario of the Sharia to a contemporary scenario to reach a conclusion. And another example of this is performing salah in the aeroplane. So obviously there were no aeroplanes during the time of the Prophet, and there is no mention of performing salah in the aeroplane in any of the sources of Sharia. But we then look and say that there are other examples of where a person is on an animal or a person is on a ship, and what is the scenario with regards to that. So then there are certain rules and certain scenarios via which it is permitted for a person to perform salah on the aeroplane. And then lastly, you have is ijtihad, where a group of qualified scholars would be able to issue a ruling based on a contemporary scenario, and this is what we have today. On slide 11, you will find that this explains the entire Sharia structure of how Islamic finance is adopted. So you have the sources of Sharia, which is the Quran, the Sunnah, and then you have what is called fiqh al-mu'amalat, which is the fiqh or the Islamic jurisprudence of mu'amalat or Islamic financial concepts. And then the application is then done by the Sharia board. So you will hear this term used quite often, is the Sharia board of an Islamic financial institution. What is the job of of the Sharia board? The job of a Sharia board essentially is for them to supervise the Sharia products of an Islamic bank or Islamic financial institution to ensure that those products are 100% Sharia compliant. And another important aspect of it is that to also ensure that the mindset of the Islamic bank is also Sharia compliant to a certain extent. On slide 12, we provide a basic definition of Islamic finance, and it's essentially Islamic finance and banking has been defined as banking in consonance with the ethos and value system of Islam and governed by the principles and maxims laid down by classical Islamic Sharia law. Now, one of the main concepts of Islamic finance is that it is asset-backed, money has no intrinsic utility, and it is a mere medium of exchange. So in other words, one of the fundamental differences between Islamic finance and conventional finance is that money is just a medium of exchange. It is just a medium of exchange, and it has no intrinsic utility. And secondly is that from a market perspective, it is based on a free market economy, obviously guided by divine principles. If you look at slide 13, you will find that these are some of the basic requirements of a Sharia compliant transaction on slide 13. Some of the requirements include the fact that it will be asset backed. So every transaction is asset backed, There is a prohibition of riba or interest. There is a prohibition of certain activities, prohibition of gharar or uncertainty. And so in other words, that the subject matter of the contract must exist. It must be specifiable and measurable. Speculative trading in financial instruments is prohibited. So in other words, that there should be complete certainty in terms of the contract. It can't be that, you know, one person says that I would like to paint your house for between 500 and 1,000 rands. So it's either 500 rand or it's either 1,000 rand. So that is uncertainty. And gambling is also prohibited, similar to conventional insurance. If you, for example, pay your premium for 6 months and you only get the benefit of 12, and you get a benefit of 12 months. So that is also prohibited. And then, as you can see right at the bottom of slide 13, as part of the requirements, profit and loss sharing. So one of the fundamental aspects of Islamic banking is profit and loss sharing, where if you invest your funds with a bank, if you invest it on a partnership basis, then you can only benefit on the basis of you taking the risk. If you don't take a risk, then you can't earn a profit. So this is one of the fundamental differences between conventional and Islamic banking, is that in conventional banking, everything is guaranteed. Your capital is guaranteed, your investment is guaranteed, etc. And your profit is fixed. From an Islamic banking perspective, your profit cannot be fixed, because then it becomes interest on a loan, and your capital cannot be guaranteed, because then you are not taking any risk. So an important factor of this is to ensure that there is proper profit and loss sharing, and this falls under the purview of a hadith in which the Prophet ﷺ mentioned al-ghunmu bil-ghurmi. So in other words, you can only take a benefit if there is risk. If there is no risk, then you can't take profits. And this is an important aspect of the mindset that we need to bring into our community, in the sense that if an investment is made, then are you taking the risk or not in that contract in order for you to gain a profit. We look at slide 14. This discusses, again, some of the major parameters which we've just gone through, in terms of, you know, a prohibition of interest, you know, overdraft facility, interest-bearing loans are all prohibited. You know, there's a prohibition of speculative behavior like life insurance. There's a prohibition of qimar and gambling. And if you look right at the bottom, Islamic finance as banking is backed by real assets or services. So unlike conventional banking, which is not necessarily backed by real assets and services, Islamic banking is backed up by real assets or services. We look at slide 15. Interest creates an artificial money supply, which is not asset-based, resulting in inflation, volatility, and the concentration of wealth in the hands of the rich. And this is exactly what is happening today in the conventional economic system, is that they call it helicopter money, or they call it monetary and fiscal stimulation. This is nothing short but an interest-based system where artificial money is created. So how is it possible that in the US, for example, the Fed prints $3 trillion without any assets? There is no assets, and dollars are just printed. So whether we call it quantitative easing, monetary or fiscal stimulus, etc., it's all the same thing, and it is based on an interest system which creates an artificial money supply, which is not asset-based. The essential of a maxim in Islamic finance is no profit without risk. So in other words, that you cannot benefit without any risk. If there is no risk, then there is no right to profits. And perhaps one of the important aspects also is that Islamic finance allows for free trade and the maximization of profit governed by Sharia law. If you look at slide number 16, this is a simple example of the difference between conventional finance and Islamic finance. So there is a person by the name of John. He requires finance for his booming mining company. So he takes out a loan of $1 million at an interest rate of 15% over the next 10 years. Now, this is essentially $150,000, excluding the element of inflated interest. Now, what happens if John's mining company, takes a loss, there is a pandemic, etc.? The bank still stands to benefit, even though John's company doesn't make a profit. When we look at Islamic finance, an Islamic bank would propose what is called a mudaraba contract. So in other words, it becomes like a Sharia compliant working capital facility. So John becomes a working partner or the sweat partner, and the bank becomes a financier. So the Islamic bank would invest the required capital, and there would be a profit sharing agreement between the bank and John. So only when John's mining company earns a profit, then the profit is then shared between the parties based on an agreed stipulation. Other examples of this include, sovereign debt. You find that there are sukuks that are structured on the basis of musharaka, on the basis of ijara, istisna. These are concepts which we will discuss further on. Slide number 17 provides some basic principles of Sharia law with regards to prohibitions, etc. We move over to slide number 19, which basically provides a snapshot of an Islamic bank. And I'll just take you through this. Snapshot very quickly of an Islamic bank on slide number 19. So you find that there are depositors, that is, an ordinary depositor would deposit funds into the Islamic bank, and then their shareholders would also deposit funds into the Islamic bank. So these funds that are deposited into the Islamic bank are either done on several concepts. It's either done on the basis of a mudaraba contract, which is a profit sharing contract, or either done on the basis of a wadiya or a qard, which is an interest-free loan by the depositor into the bank. The bank then takes those funds and either uses those funds to fund the treasury, which is a money market solution, with another bank to get money on an overnight rate, or they would fund an investment and there would be a profit that will then be shared between the Islamic bank and the depositors, or, as is commonly known, the function of an Islamic bank is to lend money. So they would lend those funds in a financing transaction to other clients of the bank. Some of the fundamental concepts, as you can see on slide 20, we'll just discuss, these concepts fairly quickly. I can see we're already running out of time. So we'll discuss the equity-based concept, which is mudaraba and musharaka, the trading-based, which is salam, istisna, and murabaha, the lease-based, which is ijara or ijara muntahiya bitamlik. So the first one on slide 21 is based on musharaka. So what is a musharaka? Musharaka is an Arabic word which comes from the word sharaka yushariku, which refers to two or more parties partnering with each other to make a profit. So this is also, this very interestingly has also been called by the early Europeans a mukhatara contract. So I have seen a document written in 800 BC, which refers to a mukhatara contract. A mukhatara contract, as per the Europeans, these are non-Muslims now, refers to the same thing as a musharaka. And the late Vatican, or the Pope of the Vatican in those days, encouraged Europeans to follow a mukhatara contract and to leave out interest-based transactions. So this obviously proves and shows, the ethical nature of Islamic finance and Islamic banking. So a musharaka refers to where all the parties share in the capital contribution, the parties share in the profits as well as losses. And remember, the one important thing is the profit cannot be set as a percentage of the capital, and the profit cannot be guaranteed in the form of fixed returns. And all mechanisms should be introduced before initiation of the partnership. So what we've generally seen now, our Muslim community, is unfortunately that there's one of two things. One is that either the profit is guaranteed in the form of fixed returns, if it is a musharaka contract, and the one party is not prepared to take a loss. If it is a musharaka contract, then both parties must be prepared to take a loss. It can't be that only one party says, I am funding the transaction, and my profit or my capital is guaranteed. The second thing, what we've seen is that unfortunately we conduct our dealings without any documentation, without any agreements. Remember that in today's times, Allah subhanahu wa ta'ala says in the Quran, Ya ayyuhalladhina amanu idha tadayantum bidayn ila ajalin musamman faktubu. That if you have to take a loan, then make sure you document it. Now, obviously, the injunction that has been mentioned in the Quran, that is the preferred method. But in today's times, it is almost wajib or fard or obligatory upon every single person who conducts a financial dealing with another party to ensure that it is properly documented. Otherwise, this leads to a lot of disputes, it leads to a lot of disagreements, etc. If something is in black and white, then it is very clear. Both parties know their obligations and there isn't any issue. So if you are conducting a dealing with someone else, make sure that it is documented. And I have certain friends in the Muslim community where, even if we have to lend them money or, we have to entrust them with funds, they would make sure that they would say, I would send you a message or I would send you an email to make sure that, that their financial dealings are documented. And one day I asked someone, but it's only a small amount of money. I know and you know that I have entrusted the funds to you. And he said, what if I die tomorrow? What if I die tomorrow and no one knows that I have entrusted those funds to him? So, and this is how a Muslim should conduct his affairs, is that the wealth that we have been given is an amanat from Allah subhanahu wa ta'ala. That the wealth that we have been given is a trust from Allah subhanahu wa ta'ala. And we don't know, we may leave this world today, we may leave this world tomorrow. And this is how we should live our lives anyway, is that, we don't know. In fact, one of the pious servants of Allah subhanahu wa ta'ala, Hassan Basri, rahimahullah, may Allah have mercy on him, he once said that, I live my life and I conduct my dealings, I conduct my life affairs on the basis that if I make one salam, I don't know if I will live until I can make the next salam. So a person is performing salah, we all know how quick it can take from one salam to the next salam. So we should always ensure that our dealings are properly documented. We now move over to slide 22, which documents the structure of a musharaka. So this is an example of a musharaka. You have a venture, you have two partners that provide funding to the venture. Let's say there's a profit of 100 rands and there is an agreed ratio of a 40-60%, a 40 to 60 ratio. So 40 rand will go to partner A and 60 rand to partner B, 40 rand to partner B and 60 rand to partner A, because there is an agreed profit sharing ratio of 40% and 60% respectively. But when it comes to the loss can't be shared as 40 rand and 60 rand. The loss has to be equally shared because both of them contributed 50-50 to this musharaka partnership. So we find many contemporary examples of a musharaka, as you can see on slide 23. And some of the common products that you find include a diminishing musharaka, which is basically when you buy a house from an Islamic bank, for example, you go to HPZ Islamic Bank, to Al Baraka Islamic Bank, FMB Islamic Bank, etc. You will find that they will provide you what is called a diminishing musharaka contract for home finance. Essentially, what this means is that the bank and you as the client, the bank's client, would jointly fund the house. So let's say you put in a deposit of 5% to 10% and the bank puts in a 90%. They would then jointly own the house with you as a 90-10 partnership, for example. And then eventually over a term of 10 years, 15 years, you will buy the bank's share out. Other examples of this include working capital finance, project financing, Islamic current or running facility. So you find that many banks would have a musharaka current account. So where, for example, the bank says that they would provide you with the funding as an Islamic current account, and then when you declare profits based on an agreed profit sharing ratio, the bank would also benefit from that. If you see on slide 24, this is an example of a diminishing musharaka. As you can see, that the asset is jointly owned between the eventual owner and the bank, and then the eventual owner pays the bank over a term, let's say 15 years or 20 years, to then buy out the bank's 75% share. If you look at slide 26, this is an example. This explains a mudaraba, an Islamic sweat partnership. So what is an Islamic sweat partnership? Essentially, it is where you find that there are many budding entrepreneurs, especially in today's times. There are a lot of budding entrepreneurs. They've got good ideas. They have certain contracts. They've got certain concepts and ideas and deals in terms of how they can make a profit, etc. But they don't have the capital. So, and then let's say you have, on the other hand, you have someone that has capital. Maybe they inherited a lot of money, or they have an Islamic fund, etc., or they have private equity. So how do you then merge the two together? Because someone can have capital, but he doesn't have the ideas, or he doesn't have the contracts, or he doesn't have the investment proposition to invest the funds and earn a return. And then you have someone that is an entrepreneur, but he doesn't have the capital. So the concept that is normally used is what is called a mudaraba, or an Islamic sweat partnership. So essentially what it means is that one party contributes the capital and the other party contributes his services in terms of entrepreneurship. Then you have different types of this. You have the restricted and unrestricted partnership, and it's all based on a pre-agreed percentage ratio. So the one important point with the mudaraba is that if there is a loss, the mudarib or the working partner cannot bear any of the loss. The mudarib or the working partner cannot bear any of the loss. So remember, this is a very important point, and unfortunately we've noticed in our community that if these things are not structured correctly, and let's say one partner contribute funding to a particular arrangement, and the other party was an entrepreneur, and the funds and there was a loss in that venture, then in actual fact, according to the Sharia laws of mudaraba, the Sharia laws of economics and finance, that party, the mudarib or the sweat partner or the entrepreneur will not be liable for that loss unless the transaction was structured in a different manner, where it is a Sharia compliant murabaha, Islamic debt transaction, as opposed to an Islamic equity transaction. So in that case, when it comes to losses in a mudaraba, the mudarib does not bear any loss. Only the investment partner will bear the loss. If you look at slide 27, this is an example of a mudaraba. You have the mudarib, which is the working partner, and you have the Rabbul Mal, which is the financier. If you look at the only difference here between mudaraba and musharaka is that you'll find that the loss, all of the loss or monetary loss is to the Rabbul Mal, which is the financier, and the mudarib loses all of his services if there is a loss. If you look at modern applications on page 28 of a mudaraba, Islamic banks offer certificates of deposits or Islamic investment certificates. You find various banks like HBZ here, we have in South Africa, HBZ, Al-Baraka Bank, etc. They provide you with an Islamic deposit account, or what is called an MDAF, deposit account facilities. Remember, the profit rates that an Islamic bank will then provide you, those are only indicative. So where you have like a profit share, provided by FMB or Al-Baraka or any of the Islamic banking offerings, those profit rates are indicative. They cannot be fixed, because as I've mentioned before, that if it is fixed, then it becomes an interest on a loan. So some of the common products for mudaraba include private equity funds, deposit accounts, mudaraba deposit account facility, etc. Then we move over to slide 29, which is a murabaha or cost plus financing. So this is one of the most commonly used concepts in Islamic finance. And from a Sharia perspective, we say that there are 48 concepts under which a transaction can take place. There are 48 different concepts under which a transaction can take place. If person A gives an item to person B, then there are 48 different concepts under which that transaction can occur. So Islamic trade and working capital finance is based on the concept of murabaha. Murabaha is a particular kind of sale where the seller expressly mentions the cost of the sold commodity is incurred and sells it to another person by adding some profit thereon. Thus, murabaha is not a loan given on interest. It is a sale of a commodity for a cash deferred price. So, in other words, as a simple example, person A is a budding entrepreneur. He has a contract to bring in, let's say, a certain product from China, for example, and he doesn't have the funds. He goes to an Islamic bank. The Islamic bank will then purchase, let's say, 10 shipments of that product from China and then sell it to the entrepreneur on a fixed or deferred payment basis over the term. The Islamic bank is entitled to take security to protect its interests. So this is one of the most commonly used concepts in Islamic banking or Islamic finance, called the murabaha cost plus financing, simply because number one is that it is a very clear and decisive concept in which an Islamic bank would engage in actual trade. Secondly is because it also protects the Islamic bank in the sense that it is an Islamic debt-based transaction where the Islamic bank is buying an item or good for X and selling it to the client for Y. We move over to slide 31, which basically provides a simple example of how a murabaha transaction occurs. So you find that the bank will purchase the goods for X for 100 rands, for example, and sell it to the customer for 110 rand. This is a simple example of how a murabaha would work. If you look at slide 32, this provides a snapshot of a contemporary example of a murabaha in Islamic financing transaction. The customer, let's say, wishes to finance 100 tons of wheat. The bank conducts full due diligence and seeks the approval of the Shariah advisor. The bank will approve the facility. And then what happens here is that instead of a conventional trade finance facility, where the bank simply loans the money to the client, the bank will then receive the invoice from the supplier and pay the supplier. The bank will appoint the customer as the agent to go and receive the goods on behalf of the bank. The bank will receive the goods via the agent, and then it will resell the goods to the customer on deferred payment for the fixed price and tenure. And the bank can charge all incurred costs to the client based on mutual agreement. So this essentially is how a contemporary murabaha transaction would occur. If you look at slide 33, this explains the three different legs of a murabaha transaction. So you have a supplier that supplies the goods to the bank supplies the goods to the client, and the client will eventually supply the goods to the buyer. Slide 34 is a very explicit and clear snapshot of the difference between Islamic banking and conventional banking. If you look at Islamic banking, you'll see that we have what is called the purchase price. That is why we say that Islamic banking is not actually Islamic banking. It is in actual fact Islamic financing or Islamic trading, because the bank is buying the goods. So then you'll see the selling price, and the tenure is fixed, and we call it installments. If you look at the conventional banking side, you'll see it's called the amount finance and the interest rate. So that is essentially the difference between conventional and Islamic. If you look at slide 35, this discusses another concept of Islamic finance, which is called the ijara concept. So ijara basically means that where a person purchases either the usufruct of an asset or the usufruct of an individual. So what this basically means is that there's two types of ijara. One is ijaratul ahmal, or ijara where a person is hired to conduct certain services, and this is where most employees work for an employer. This is referred to as one form of ijara. And then you have the other form of ijara, which is called ijaratul manafi, which means the transferring of usufruct, or the leasing of a usufruct of an asset. So in other words, if I own a house and I lease the house to someone, I am leasing the usufruct, or I am selling the usufruct of the asset and not the actual asset. Some of the important fundamentals of ijara include that where if the asset becomes destroyed, then the liability of ownership is only borne by the lessor or the owner, not by the lessee. The other important aspect of this is that you are in ijara, you don't sell the asset. Now, one of the main differences here, if you look at slide 37, is that it is not like an HP or conventional HP or hire purchase agreement, whereas that is essentially a loan. But if you look at ijara, in ijara, basically the Islamic bank will purchase the asset and it will then lease the asset to the client. And this is how Islamic vehicle financing is conducted. So if you look at slide 38, this is an example of ijara. So you can see the bank purchases the asset, it then leases the asset to the client over the term. We now move over to slide number 42. So this again is another concept of Islamic finance and banking called salam. So what is salam? During the time of the Prophet, there were many Sahaba companions of Rasulullah sallam that used to farm. They used to conduct agricultural business. They had agricultural businesses. They used to conduct farming. They had agricultural enterprises. So they would say that, many buyers come to see us, but we can't sell the goods or we can't sell the crops until we have the crops. And sometimes we need the money. We need the money before the actual crops are harvested. So we end up spending, many, a long period of time without any funds. So based on that necessity, Rasulullah sallam then allowed for salam. So salam is what is called an Islamic forward sale, where items can be sold. Based on a forward sale, as a Sharia compliant forward sale. Now, the contemporary example of this is that there are many contemporary examples of this. One example of this is called drop shipping, where many people sell items online via e-commerce. You don't own the goods, you're selling a good that you don't own or you don't possess. And how is that permissible from a Sharia perspective? So then the concept or the Islamic concept of salam will be applicable. But remember, in salam, there are certain preconditions. That is, if you're selling something which you don't own, then there are 6 or 7 conditions that have to be specified. The first is that the actual item, the quality of the item has to be specified, the quantity, the location has to be specified in terms of where the goods would be delivered. The price has to be fixed, and the subject matter of the sale has to be something that is what is called a fungible commodity. So in other words, that it must be something that can be replaced. It must be something having of value, etc. Look at slide 43. This is an example of a salam contract. Now, those of you who know, there is a bank in the United Arab Emirates called Dubai Islamic Bank. Dubai Islamic Bank offers their clients what is called a DIB sugar financing product. Basically, what that refers to is where the Islamic bank purchases sugar from a mill and then it sells the sugar on a parallel salam contract or parallel Islamic forward sale contract to the final buyer, which is certain corporates based on a fixed margin. And then the margin is then distributed as profit between the Islamic bank and the depositors or the investors of that product. So as you can see on slide 43, the Islamic bank would then purchase goods from the client. So the moment the Islamic bank purchases the goods, they will only receive the goods at a later stage. But what this does is that it injects liquidity into the system. Now, when we talk of injecting liquidity, we're talking about fiscal stimulus and monetary stimulus and policies. Then we have the best stimulus, we have the best fiscal stimulus in the Islamic concept and in the Islamic system. Instead of printing free money, why can't we inject actual money against Islamic forward sales, thus creating more value in the system? By creating fake dollars, creating fake money, that is not creating value in the system. We're not creating new assets in the system. And just one example of this is, the concept of value creation and wealth creation is, if you look at the credit or conventional monetary system, that the actual GDP to credit or debt based on global economics is quite staggering. The current total debt outstanding globally is sitting at $800 trillion, and the global GDP is sitting somewhere around 50 to 60 trillion dollars. So you can see the difference between the actual output, because GDP refers to gross domestic product in terms of the actual output of the combined global economies, and you compare that to the actual debt. So in other words, that is debt really creating value or not? So when it comes to these concepts here, this is actual value creation, because the client or the producer has to produce a commodity to sell to the Islamic bank. But the Islamic bank obviously is not in the business of buying sugar, etc. They will then sell it to the final buyer, and on whatever margin they make, they then distribute it with their investors. We could move over very quickly to slide 45, which discusses takaful. What is takaful? Takaful is Islamic mutual indemnification. It is similar to an Islamic cooperative where each members indemnify each other. The Islamic takaful industry, is worth several $billion. You find here in South Africa, we have, one provider which is called Bright, previously called Zurich. So we have Bright Takaful, and this product has been in the market for the last couple of years. So if you look at slide 48, slide 48 discusses the difference between a conventional takaful or conventional insurance product and a takaful company. So you find with the conventional insurance product that all of the funds go into one pool, and it covers expenses, reinsurance, etc. The funds are also invested into conventional or non-Sharia compliant stocks. If you look at an Islamic takaful company, you'll find that there will be two funds. One fund that will cover the investment income, the other fund that will cover the claims, etc. On slide 50, we'll briefly go through sukuk or Islamic bonds. Sukuk is an Arabic word which refers to the word sak. It is a plural of the word sak, the Arabic word which refers to a certificate. So sukuk are basically certificated Sharia compliant financial instruments, and commonly translated as an Islamic bond. If you look at the definition by the Islamic Financial Services Board, or the IFSB, it says certificates that represent the holder's proportionate ownership in an undivided part of the underlying asset where the holder assumes all rights and obligations to such asset. Now, one of the fundamental differences between a conventional bond and an Islamic bond is that an Islamic bond is not asset-based, but it is asset-backed. So there's an actual asset that backs your, that is basically backing your investment. Secondly is that, the funds can only be invested in Sharia-compliant activities. Thirdly is the prospectus or the documents or the terms and conditions are vetted by the Sharia board or reputable Sharia scholars to ensure that that prospectus is Sharia compliant. In other words, that there's nothing there related to interest, etc. What are some of the benefits of sukuk? Well, obviously the benefits of sukuk, and here we're talking of corporates or companies or businesses, is that now you will have a different investor base, you will have liquidity, you'll be able to raise Sharia compliant funding. And obviously we find here in South Africa that we've seen several state-owned agencies like Eskom, Transnet, etc., looking at the possibility of sukuk. Our own South African government issued a sukuk in 2011 for $500 million, and at the time they had paid the lowest coupon or profit distribution at the time. So it shows that there is an interest, and Islamic sukuk or Islamic bonds are viable products. If you look at slide 51, these are specific Sharia guidelines around sukuk. So the funds have to be used for Sharia compliant activities. It has to be backed by tangible assets, and the income received by the investors has to be through actual cash flows. Number 6, no fixity in returns, and there's no financial guarantees, and all of the activities has to be screened for Sharia compliance. If you look at slide 53, slide 53 discusses the differences between sukuk and conventional debt instruments. So we'll go through that very quickly. So each sukuk will represent the ownership of the underlying asset. But if you look at a conventional debt instrument, bonds represent pure debt obligations due from the issue. So it's a debt obligation, but it's not backed by ownership. The majority of the sukuk corresponds to the underlying project. If you look at a conventional debt instrument, The core relationship is a loan of money. So essentially, there is no concept of looking at the underlying project. The prospectus is Sharia compliant. The underlying project is Sharia compliant. If you look at a conventional debt, we don't know where those funds are going into. It could be Sharia compliant, could be non-Sharia compliant. The sukuk holders have the rights to profits, but also bear losses. And if you look at a conventional bond, you are never exposed to any losses. If you look at slide 54, I will just go through some of the quick, concepts of sukuk. There are different forms of sukuk. So you have the musharaka sukuk, where the funds are mobilized for establishing a new project. For example, investing into a property development, etc. You have a mudaraba sukuk, an investment agency sukuk. So let's say, for example, you have a business and you want to raise capital from the Islamic capital markets. You can then be an agent on behalf of the investors to then procure the funds and then invest it into the business. If you look at slide 55, there's other sukuk in terms of a mugharasa or a muzara sukuk, which refers to a sukuk for agricultural purposes. And I think perhaps, some of these concepts can be further explored, especially in the context of Africa and South Africa, in terms of, investing into agriculture in the country, investing into agricultural projects, is how can we create, these agricultural sukuks so that funds can be then deployed to expand the agricultural sector. I'd like to take you to a quick example of a sukuk. Let's go to slide 58. So slide 58 discusses what is called the sukuk al-ijara, which is a sukuk backed by Islamic leasing. So let's say, as an example, there is a company that leases vehicles and they want to raise capital. So how would they do that? So they would structure what is called an SPV, which is basically an entity or a company. Some of these companies can be, can have bankruptcy protection. Some of these companies are based in offshore jurisdictions simply because they offer tax neutrality, tax parity with other jurisdictions. There's no, protections. There's no tax issues, etc. Some of the common offshore financial hubs include the Isle of Man, Jersey, Cayman Islands, Bermuda. And some of these offshore havens, provide special, offshore corporations where promoters or companies can issue bonds out of those entities. So you have what is called the investors or the sukuk holders. They would invest into this issuer SPV, and then the issuer SPV would then purchase the assets. Let's say you as a business, you lease vehicles. You would then sell your vehicles to this company. This company will then lease those assets back to you over a term. So let's say whether the term is 5 years or 7 years, every year you would then pay back the investors a coupon, which is the correct term in terms of a bond. And then after this 7 to 10 year term, you would then repurchase those assets. So essentially, what you have done as a business is you have freed up your assets to inject liquidity into your business. So let's say if you are a fledgling property company, for example, your company is worth 100 million rands. No one would buy your properties right now. So a simple way of doing it is to issue a property sukuk or an ijara sukuk, where you sell your assets to the company. That company will then lease your assets back to you. Essentially, you've freed up your liquidity, and after a 7 year term or 10 year term, you would then have profits to then go and buy back your assets. So we move over to slide number 62, which discusses some contemporary issues around Sharia compliance. So remember we said that the Sharia Supervisory Board has to ensure that the underlying structures are Sharia compliant. Another important point is that every transaction has to be separated and individualized. So you can't have two transactions in one. And there should be proper Sharia audits that are conducted. I will now move over to Sharia to slide number 63, which is Sharia asset and investment management. So this is an important factor that the Sharia asset management industry is growing. In South Africa, the asset management industry is probably worth about 50 billion rand. And it is estimated that there are over $500 billion worth of assets in Sharia compliant investments. There are over, now it's probably over 2,000 Islamic funds globally. Islamic pension funds is worth over $50 billion globally. If you look at slide 64, there are various types of Sharia compliant funds, private equity funds, etc. And more importantly, if you look at slide 65, we discussed some of the important screening criteria of Sharia compliant equities. So if you look, there's an industry screen in which certain activities are impermissible, like conventional banking, alcohol, etc. Then we have what is called the Islamic stocks selection criteria. So there's a screening criteria in terms of the total debt to market capitalization, accounts receivable to total assets, etc. And you can contact us if you wanted to screen any stocks to ensure that they are, that they are Sharia compliant. We've seen a lot of activity in the retail, stock and equity sector, where a lot of retail investors are seeking to buy cheap stocks in the market. And obviously, those stocks need to be screened for Sharia compliance, and there's a proper screening criteria that one can use. I will now move over to slide 93. Slide 93 basically discusses some of the guiding principles of risk management. The various risk management guidelines. If you look at slide 94, we have what is called the Islamic Financial Services Board, in which GIFS, or Global Islamic Financial Services, is a member of, and there are over 14 IFSB guidelines in terms of risk management from an Islamic financial and banking perspective, that covers various aspects and various topics. And I would like to terminate by going to slide 124. So basically, slide 124 covers a snapshot of Sharia governance of an Islamic financial institution. You find that there is, that there is a board. You have a Sharia committee that reports to the board, and then you have different Sharia functions. So you have a Sharia risk management control function, Sharia review function, Sharia audit function, Sharia research function. So, you have different functions in an Islamic financial institution to ensure that the product that you receive is 100% Sharia compliant. And this is where we say that, if you are purchasing a Sharia product or Sharia banking product, make sure that you check, that these protocols are put in place to ensure that when you invest your funds, those funds are not simply, invested into a conventional deposit and then you receive a Sharia compliant return. Make sure that there's a proper Sharia audit that is conducted to ensure that you are receiving, a proper Sharia compliant return. So with that, we move over to the last slide, which is slide 133. And this discusses some of the basic Islamic banking products out there. You have a Sharia compliant current account, Sharia compliant home finance account, trade finance products, FEC and FX products. If you are, importing and exporting, goods, there are Sharia compliant products for that. There are also vehicle asset finance products. Importantly, also, during COVID, a lot of businesses are looking for liquidity, in a difficult spot. If you have assets available, you would be able to refinance those assets on a Sharia compliant basis, etc. So there are various Sharia compliant options out there from a Sharia perspective to access finance. But what I would say before I terminate is that Islamic finance and Islamic banking is not only about how we can finance our homes, how we can finance our businesses, etc. This is an essential facet and element of our lives as Muslims. Is that one of the fundamental tenets of Islam is muamalat, or our financial dealings. How can we ensure that our financial dealings are Sharia compliant? This is where the hadith of Rasulullah ﷺ is applicable. طَلَبُ كَسْبِ الْحَلَالِ فَرِيضَةٌ بَعْدُ الْفَرِيضَةِ. That to seek a halal income is an obligation after an obligation. Just as it is important to perform salah, equally important it is for us to ensure that our dealings are Sharia compliant. So let us, make a firm intention and have, a serious desire for us to learn more about Islamic finance and economics. There are many, competent ulama, scholars out there, practitioners. We can also go online. There are many resources out there on Islamic finance. Alhamdulillah, we have also written a book on the subject called Your Brief Guide to Islamic Finance, which if you email us, inshallah, or you can email the Minara Chamber of Commerce, you'll be able to procure a free copy of that book. Before we end this program, I would like to field a few questions. And if there are any further questions, then we would be happy to answer them. You can send those questions to the Minara Chamber of Commerce, or you can send it to us on our contact details, as you can see at the last slide, CEO@gifsrv.com. Again, CEO@gifsrv.com. You can send your questions there, or you're welcome to to WhatsApp me on 066-234-9000, 066-234-9000. So there are a couple of questions that we've received. So the first question is, to clarify, capital cannot be guaranteed. If risk is shared in the working capital arrangement and the bank would share in loss, then I assume capital is not guaranteed. So yes, as we've clarified, that the capital cannot be guaranteed under certain concepts, and under other concepts like a murabaha, for example, then the capital can be guaranteed, because essentially it is not an Islamic profit sharing agreement. So an Islamic profit sharing agreement, in the case of a musharaka or a mudaraba, yes, in that instance the capital cannot be guaranteed. So if, for example, if you are making an investment with an Islamic bank and they tell you that it is a mudaraba, certificate of deposit, then in that instance your capital cannot be guaranteed. But if they tell you that if you've invested your funds on a qard al-hasan, then in essence it is not an equity product, it is an Islamic debt product, where you have basically lent the Islamic bank your funds. So in that case, your deposit is then secure because it is a debt-based transaction. So that's essentially the answer to that question. The second question here is, there any Sharia views on charging excessive profits? So obviously, the only perhaps example of this is what is called ihtikar, or where there is hoarding. So and we've seen this, price gouging and hoarding during the time of this pandemic, where individuals had purchased certain PPE equipment for them to hoard it and then charge excessive pricing. This here is referred to as ihtikar or hoarding in Sharia, where there is a definitive requirement for a product and then you charge excessive profits. This has been not prohibited, but it is makruh and reprehensible in the Sharia. So remember that when it comes to our financial dealings, as they say, that if the money that you've received is it is tainted, then how can there be barakah in your life, and how can there be barakah in your wealth? So remember now that to conduct your business dealings in an ethical manner, in a Sharia compliant manner, this will only bring barakah. This will only bring barakah, and it will bring financial happiness, and it will bring financial benefits and blessings to your wealth. So to answer the question, yes, it is makruh to charge excessive profits in the case where there's hoarding, etc. That will be impermissible. Otherwise, if there wasn't any case of hoarding, etc., and a person is simply selling a product, etc., then in that case, there's almost no limit in terms of what you can charge. But obviously, that should be market related to a large extent. So with that, inshallah, we would terminate this program. I would also once again like to thank the management of Minara Chamber of Commerce and you, the participants, for attending this program. And as I've said, is that if you have any questions and you would like also a free copy of our book on Islamic finance, please don't hesitate to contact the Minara Chamber of Commerce, or you can contact us at Global Islamic Financial Services for a copy of that book, inshallah. And with that, I would like to terminate the session and I hand over to our respected MC.
Jazakallah, Mufti Saab. That was a very interesting discussion on that. First of all, Jazakallah to all our participants before you ring off. Thank you for your involvement in this. Thank you for those questions that we had. I know to get you guys on a Saturday morning at 9 o'clock, it's a great sacrifice after a long week. But nevertheless, we appreciate your participation in this today's discourse. Mufti Saab, Jazakallah, thank you for this very interesting discourse. I'm sure we all enlightened more today than we were yesterday. So thank you for that. And also it was a good overview of how banks operate in the Sharia universe. On behalf of Minara Chamber of Commerce, we pray that Allah subhanahu wa ta'ala grants you good health and long life so that you may impart your knowledge to our community at large. And if there's no other question or any other contribution or comment, then I would like to say Jazakallah and Fi Amanillah. Jazakallah. Assalamu alaikum wa rahmatullah.